Well, I'm delighted to be giving a lecture during the daylight hours. You may or may not know that Gresham lecturers or professors are mostly tied up in a crypt at night and only let out once the sun has gone down. And hence, previous to today, I've only been allowed out to give my lectures at 7 o'clock or beyond. And I think it's mostly because perhaps some of my lectures might scare people, but I hope this one doesn't scare you. But the topic seems to reflect fear in the sense that we're going to try and understand why investors want an excess return for holding equities, shares in firms. And the standard answer that economists have come up with is that we're scared of holding them. We're scared of holding equities, and because we're scared of holding them, we want a little comfort, a token, a risk premium, something just to make us sleep better at night. Better not call it Mogadon, but something that makes us feel less concerned about holding these risky assets that are tremendously volatile. And so I want to think about whether that's a good way of thinking about equity prices. I also want to spend a bit of time looking at the data. I'm going to run a simple simulation and imagine what kind of money you might come out with if you invest in bonds or equities. And then I'll end up with some conclusions, which we may then take a view about bonds and equities. Now, the standard idea about equities is that simply, if you invest a certain amount of money in equities and roll over for many years, you'll make a very large return relative to the alternative, which might be a short-term government bond, a T-bill, if you will, that might operate over 3 months, and you roll that over. And so we can look at the data in the post-war period, and I'll start with the US, but I'll talk as much about the UK as I will the US. But as with a lot of ideas, the idea, the observation, the very thought emerged from work done by US academics in the 1980s. And so I looked at the US data, and I said, well, look, if I invested $5 in 1950, of course, that was some years before I was born, so let's suppose I had a kindly grandparent who stuck $5 in an account for me, and they made one of two choices. One which was to invest in the $5 in some kind of stock market index and roll over the returns every year. So whatever the return was at the end of the year, they put that back into the stock market index. That's one way they might have done it. The other way is they might have put £5 into the T-bill market, a mutual fund of some sort, and roll that over as well every year for the next 65 years or so. And if you invest and reinvest in bonds or invest and reinvest in equities, the kind of money you would have got at the end of last year was about £83 if it was in T-bills, $83 I should say, $83 if it's T-bills, and just over $600 if it was in equities. If we turn this into an average annual rate of return, this is nominal stuff. I'm not going to deal very much with real stuff here. Inflation affects bonds and equities the same way, so I'm not going to worry too much about real stuff here at the moment. And if we look at the average rate of return there on bonds, we're about 4.5%. And equities, it's just over 9%. And if we compound that over a lifetime, 65 years, of course, is not quite a lifetime. I think it's a good thing that we live longer than 65 years. But let's say a large fraction of lifetime. We're going to end up with some quite large differences in the final amount we have in our pocket. And the question we want to concern ourselves with is whether this excess return is what we might call a free lunch. Is it just something that we can get without taking any risk? Is it something that's just given to us? As something we should just gobble up and say, thank you very much, equity. I'm going to have this, and I'm going to have more money in my pocket. Or is it being given to us because we're bearing more risk by holding equities? Is it an exchange for something? Are we bearing risk from holding shares in firms that may go up or down in value, or may indeed go bankrupt, or may not exist anymore? And therefore, the excess return is just that compensation I talked about a minute ago to help us sleep better at night. And what we to get at the risk, of course, is the standard deviation of the returns. That's just a statistical idea about the extent to which we might expect those returns to change relative to the mean. Just think of it as a probability density function or histogram placed across the average returns. And for bonds, the standard deviation is a fraction over 3%, but for equities, it's 6 times that. 16.8%, which means in any 1 year, we don't really know whether the equity return will be positive or negative. Because you'll note and you're all smart, I can see, that 16.8 is greater than 9.1. So in any one year, you could easily have a negative return in equities if the standard deviation is larger than the average return. The difference in average returns measures the post-war market price of risk in the UK. So it tells us how much, if this is an equilibrium phenomenon, we wanted, as investors, in aggregate, assuming no distortions, to accept the level of risk I've just described. And the question we want to ask as economists, is that an equilibrium level of risk? Is it something that prices fairly the quantity and price of risk so that we're in equilibrium? Or is it excessive? Is it something that we can't understand? And if it's excessive, that matters. Because it means that firms that have to raise equity have to pay more for it than they would otherwise if it wasn't excessive. And if they have to pay more for capital, that might prevent them from investing. It might ultimately lower the rate of growth in the economy, if we think that capital accumulation or investment is a long-term cause of growth in the economy, or the level of GDP per head. Or is the premium too low? Should it even be higher? Because if it's too low, it's going to provide a disincentive to save. And why do we save? Well, we save if we have more income than we have current. If we have less expenditure than we have current income, if we have less expenditure than we have current income, we can accumulate financial assets, which is what we mean by saving. And why do we save? Well, if we're rational and we don't care about our children, which might also be rational, but I'll leave it to you whether it is or not. In my case, I think it's rational. The more I care about them, the more care they want. That's the problem. Moral hazard. But if I'm rational, what I want to do is save today from excess income sufficient so that when my income is lower and my expenditure is higher, I can fund that future expenditure. So what I kind of want to do is save enough so that whatever shocks come along in the future, I can maintain a reasonably constant level of consumption. So I want to purchase a set of assets that give me a payoff when my own income-constrained level of consumption is low. That's the activity that I'm running. But if the rate of return I get from equities is not sufficient to give me those payoffs at a particular time in the future, there may be trouble ahead. This kind of gives us some background to what we might think of as a pensions crisis or a lack of savings in the economy. And if that's the case, we might have to borrow from abroad. And it's all kinds of issues with capital flows. But let's stick, as far as we can, to the point in hand. Now, just to illustrate, let me go from some numbers to a simple chart. All I've done is just accumulate those $5 from 1949, 1950, and showed you where you end up with bonds and where you end up with equities. Now, to turn these numbers into something we can all understand, I had a bit of fun this morning trying to see what I could buy with $5 in 1950. And it turned out I could buy about £5 in weight of porterhouse steak in Maine. That's what $5 could have bought me, a very large meal, probably for my family, I think. A pound of steak is quite a lot, isn't it? So £5 of steak, that's what it could have bought me. So the $5 then got me £5 of steak, and if I'd sold the £5 of steak and put it in bonds, at the end of 2014 I would have had, what was the number I had? About $83, which I looked at this morning. It's a busy weekend for the trains in the US, but it's about the price of a one-way ticket from New York to Washington, D.C. Train to Washington. So it can get you a train to Washington, if you know the song. And that's what it could get you. Sorry?
How many pounds of steak would it get you?
Well, that's a question for another time. Thank you. Probably about the same. And the equity payoff of around $600 would approximately buy you a new iPhone in the United States. So that's the kind of returns you'd get from the two alternatives, a train or an iPhone, which you may think I'm indifferent between the two, or you may think I prefer the iPhone, but I'm kind of transferring these numbers into something that we can understand in terms of commodities. Now, the fear that many of us has when we come to equities has been very well written about by our old friend Isaac Newton. You may remember, those of you who were fortunate enough to come along to my inaugural lecture, we talked about Isaac Newton. We talked about the fact that after working out gravity, he was desperate for a government job and ended up as Master of the Mint in 1717. He set the relative price of gold and silver And even though he could get gravity right, he couldn't get the relative price in gold and silver right, got the price wrong, and led to silver being forced out of circulation, and we ended up on a gold standard. He actually didn't do very well, it seems, in other areas of finance, because what he wrote on the South Sea bubble was that I can calculate the motions of the heavenly bodies, but not the madness of people, he says. And this is because, we can see the numbers here, in 1717 setting up the gold standard. This black line is a kind of reconstructed equity price index for the first part of the 18th century. And so I've normalized it at 100 in 1717 when Isaac Newton's sitting somewhere over there as the master of the mint. And we can see that some 40 years later it's still about 100. Didn't give a very good rate of return over that period. And part of the reason, I guess, it didn't do particularly well in the 20 years or so after the end of the was the very bubble and crash that we see in the middle there, 1718, 1719, 1720 South Sea bubble, and then the crash bring it back down to 100 at the end of 1720. Earlier in 1720, he'd sold his shares at some point when we're going up, presumably around here, made a profit of 7,000, and then he bought an even larger number of shares, presumably around here, and lost the lot. In fact, according to Charles Kindleberger, he lost £20,000, which I think was probably a hell of a lot of Porterhouse stake back in 1770. It might have been several farms in Wales. I don't know, we can find it. Perhaps we could get someone to find that out. And apparently, so Kindleberger says, never for the rest of his life could he bear to hear the name South Sea. Unfortunately, life wasn't there very long. It was only 7 years. He didn't have to bear it. But the fear of equities, the fear of the volatility, the fear of losses that he suffered then and talks about seems to be something that's endemic to this day and might help us understand why we want a higher return for bearing the risk. Now, the numbers that we've been presented from the US academics are often treated as a universal constant, perhaps like the speed of light. Unfortunately, in economics, we don't tend to have universal constants, which is a good thing because it keeps many of us in employment, giving lectures, working in the city, setting monetary policy, all those things. It's kind of nice. There's a lot of uncertainty. And we can do a similar exercise on UK bonds and equities, and we can do a longer run exercise. We've got a nice long stretch of data in the UK. And we can see what happens from £1 invested in 1717. This is by Newton. Presumably he kept it for his descendants somewhere or other. A £5 for Waterloo and Wellington in 1815. A £5 again. I've done a £5 again because there was no drift in the price level over this period. In fact, the price level was very much the same in 1717 as it was all the way up to about 1914. No drift, no positive annual inflation over this period. So we do a £5 again for the accession of Edward VII in 1901. I moved to a tenner by the time Churchill comes back as Prime Minister in 1951. And I remember the reissuance of a £50 note in 1981, so I've stuck that in as well, just to see what I get. So I've just taken a random number of events, tried to pretend I'm doing something serious, but I guess I'm just trying to illustrate, using the UK data set, whether we get this excess return for equities that some people would tell you is always and everywhere a phenomenon to be observed. That's all we're doing, just having a look. Nothing more than that. Excuse me. So the column that says bonds just gives you the final amount in 2014 from the bond strategy, investing £1 and rolling over in bonds, from the equity strategy over that very long period of nearly 300 years, for Waterloo, for Edward VII, Churchill, and the £50 reissuance in 1981. And what you can see is that it certainly helps to live a long time if you can avoid spending any money, because through compound interest you can do very well. Well, that's good. But despite the advances in medical science, I sadly don't think I'm going to be around in a couple of hundred years to see what happens to my pound. And as I don't care about my children, as I've pointed out earlier on, I want to return over a slightly shorter horizon than that. But let's anyway look at the data. Over the very long run, bonds seem to dominate equities. So the bonds, which may be less risky, seem to give you a better return. Equities are sort of beaten into the ground over this very long run. If we remove the 18th century war after war. The aftermath of the South Sea bubble seemed to lead to a long period of negative returns in equities. If we remove those wars and those problems out, the French Revolutionary Wars, just take them all out of the system, say that we're done with that. And we go from 1815, so the midst of the Industrial Revolution, and then look at the return from equities, which remember are shares in firms, which are profitable, and bonds, which are just essentially returns on government, raising taxes to fund its expenditures. There's more of an equality there, an average return of around 4% in both cases. If we jump forward another 80 or so years and look at Edward, in fact, once we account again for the whole of the 20th century, again we have two pretty severe wars, which again are going to be presumably affecting firms' profitability in pretty bad ways, as well as affecting people in a catastrophic manner in many cases. So let's not make light of that. Bonds again seem to dominate. You remember, of course, the UK hasn't defaulted, so the bonds, in a sense, were not ones that you were taking any great risk with. Equities, on the other hand, do half as well. And indeed, it's only in the post-war period that we can see that equities start to dominate, marginally from the 1950s, and perhaps a little bit more dominantly from the 1980s. And in fact, if we take our £50 in 1981, and I ended up with £327 today from a bond investment strategy, I noticed that's about the price of a return trip to Manchester on a train this morning. Would you believe? £327 to go to Manchester and back. The £566 would, again, spookily, buy you an iPhone at John Lewis 6S, apparently. So that's where we'd end up with these types of investment. Let me pictorially show what we mean by returns and risk. The top diagram just shows, so just to make it clear, the top diagram refers to interest rates or bonds, and the bottom diagram refers to returns on equity. And what we can see is that the bond returns are fairly tightly bounded, between 0 and 16%. These are the number of annual observations. So in about 17 or so, you can see the most majority of the time, we seem to be in the range 2 to 8%. That captures most of the distribution. Since 2009, of course, that's the period we're currently in. It's a very low rate of returns. But if we sort of take that out of the system, we can see that what the bonds tend to do is give us quite a lot of certainty. We kind of know the returns are going to be somewhere in the range of 3 to 10%. And if we take a long run, this is from 1950, we have some sense in which we know what the returns are going to be year on year from bonds. With equities, on the other hand, these numbers, here they range from 0 to 16, are ranging from minus 60 to plus 140. Even if we took these two out as extreme outliers, we'd still have a range from minus 40 to plus 40, with a large amount of distribution somewhere in the middle. But what we can notice, of course, is there are a significant number of periods of negative returns in any one year. So if you happen to be born in a particular year and you start investing, and in that year randomly there's a negative shock to equities, your initial endowment cannot necessarily catch up with someone who was born in another year for whom the initial shock was positive. So there's lots of randomness in your final amount. It depends upon very much your luck in the first couple of years, which is not really in your hands when you start saving. And this is the key to the concern we have with equities. Now, an analogy I use in the transcript, which I'll talk about here, but in the paper, is that we can kind of think about bonds, if we go back to Aesop's fable, as like the tortoise. Whatever happens, they plod along. They give you a certain return. And the equities are a little bit like the hare. They sort of run around really fast, but every once in a while they get exhausted and they need to take a nap of uncertain duration. And we can think of these naps as uncertain durations as sudden stops, equity crises, worlds in which equities give a negative return for a number of periods, and we don't quite know how and when they're going to start giving you a positive return again. That's the risk we hold. We run by holding equities, that we're backing a hare who's a little bit scatterbrained, and we don't quite know when the hare's going to take a break, take a sleep, And we also don't quite know when the hare's going to get up again and join the race. On the other hand, the tortoise just keeps plodding along, which may be very valuable to us. In a world in which we don't quite know when we're going to be born, we don't quite know when we're going to need the money, a world in which we know with certainty what we'll get, maybe a world in which we value the bond. And then, if it's a world in which we're scared of the equity for the reasons that I've said, we demand a higher return from it to compensate us for the fact that we don't know where the hare is going to be at any particular time, we don't know what its return is going to be. So what we want to do is think of this as a world in which there's an indifference curve. Now, we talked about this in the last lecture, but I'll just rehearse it briefly, and we'll be able to understand it together. I think of a world in which we have a certain amount of wealth, and we don't care about risk, and then we're said to be risk neutral, because all that matters to us when we think about how well off we are is the level of wealth. Risk doesn't reduce our level of utility, how well off we feel. If, on the other hand, we're risk averse, what it's saying is that every time there's a bit more risk, to make myself equally well off, I require a slightly higher rate of return to compensate me for it. So my indifference curve, the points along which I'm indifferent, I don't really care whether I'm here or here, is upward sloping if I'm risk averse. Now I've linearized this, and in a minute I'll make it non-linear, but it's all very easy. We'll understand it together. In principle, what we're asking is, yes, equities are riskier, therefore they're going to give me a higher return, but is the return a free lunch? What I mean by that is it a return that places you on a higher indifference curve up here? Or is it a return that just places you on the same indifference curve? That's the question that economists are wrestling with. And we're quite good at wrestling with things for a long time. It keeps us in work. And this is the point. The US market, the bonds are giving 4.5%. The risk, as I've said, is 3%. And for the equities, I'm getting a return of 9.1%, and my risk is 16.8%. And the question we're asking is this an equilibrium on which we stay on the same indifference curve, or is it this free lunch that we should buy equities because they make us feel better off? And they don't make us feel better off because we enjoy the ride. We don't enjoy, with our binoculars, looking at that hare and wondering when is that hare going to stop and when it's going to start again. But because the hare is risky, we demand a higher return from investing in the hare, and that makes us better off. We're able to buy the hare, the returns that the hare gives us, more cheaply than we would otherwise, so we get a higher return. That's the question we want to pose. Now, let's turn this conceptual discussion into something that we can measure in numbers. And in order to do that, we have to do a little bit of theory. It's not going to be too much, and it's still early in the day, so I'm sure we'll all get there together. So what we have here is just some mapping from a level of consumption that might be given by the payoff from a bond. This is 40,000 or 40, it doesn't matter, just some number, 40. And I've said, look, in order to understand 40, I want to turn it into utility space. And this is what I'm doing here. And so I take my 40 and I say, look, I'm going to have some mathematical function that turns whatever level of endowment I get, and any bond payoff or equity payoff, into a level of utility. And we'll assume that the utility takes this form. And what it's saying is that higher levels of consumption lead to higher levels of utility. This is upward sloping, just like the linear chart that I saw before. But all I'm going to do now is make it slightly non-linear and say that every additional level of consumption leads to a slightly smaller increase in utility. So just imagine you're drawing the slope here. Small increase in consumption leads to a large increase in utility, but by the time I get really wealthy, I'm sick of the whole world, and no matter how much extra payoff I get, it doesn't increase my utility by very much. Just a diminishing return type story. Because when we see the extremely wealthy, it looks like they seem to be enjoying themselves very much. So we might want to criticize this. They seem to be enjoying their yachts and their champagne and caviar. But I'll leave them to it. That's not a world in which I inhabit. I'll think about this world, which is mine, somewhere down here in my case. So, we can think of, if I will get 40,000 with certainty, I know that's my utility level. Now, let's introduce risk. Let's suppose I say, there's my 40,000, but let's suppose 50% of the time I get 25 and 50% of the time I get 55. The expectation of half of 25 and half of 55 is 40,000. So the fair price of a bond which pays off 50% of the time 25, or an equity in this case, 50% of the time 25, 50% of the time 25, 50%, 55, is 40. That would be the fair price, because that's what you're going to get if you run that gamble many, many times. Just like a coin toss, you're going to know what you're going to get on average. But let's have a look. The utility I will get in expectation from 25 is this point, and the utility I will get in expectation from 55 is this point. The average of the two is that point here, which we can see is below the amount of utility I would get if I got 40 with certainty. The midpoint here is below what I would get if I definitely was going to get 40,000 every time. I don't like the gamble, in other words. This average level of utility corresponds to a certain, when I mean certain without any uncertainty attached to it, payoff which is less than 40. And let's suppose it's 35. That means, because the bond payoff is risky, I'm not prepared to pay 40 for it, even though that's my expected payoff. I'm only prepared to pay 35. The ratio of 40 to 35 gives me the risk premium at which I'm prepared to buy the bond. I'm only prepared to buy it at a discount because I don't like bearing the risk. The less I'm prepared to pay, the more risk averse I am. The more I'm prepared to pay, the less risk averse I am. And that's what we want to try and understand. So what we now want to do is see if we can understand the risk we have by equities, try to understand how risk averse individuals are, and see whether that gives us a sensible price of equities. That's where we want to go next in this analysis. So, that nonlinear shape that I've just drawn corresponds to this kind of utility function, where gamma is the coefficient of relative risk aversion. I'll explain what that means in a second. But I just want you to understand that this particular expression here is simply the same as that concave function that you saw on the board a minute ago. It's the same expression. We've just turned it into something we can estimate and use as economists to get us an answer. So I take the same calculation. Half the time I get 25,000, half the time I get 55,000, and I turn the payoff into utility space by sticking W as 25 or as 55, and that gives me a number here. Half the time gives me a half here, half the time gives me a half here. And that gives me my calculation, and all I'm doing is solving for the certainty equivalent amount. So if I have no risk aversion, I'm risk neutral, that flat line, risk doesn't bother me, the certainty equivalent amount is 40,000. If I'm risk averse, at 2, the certainty equivalent amount is 35,000. Well, slightly under 35,000. So as I become risk averse, the amount that I'm prepared to pay is going to be increasingly less than 40,000, and the risk premium is therefore the ratio of 40 to that number here. Now let me just illustrate with a point. By the time risk aversion gets very high, let's suppose we take a number like 10. That means, in a sense, 10 is just a number. It doesn't mean anything. So let me explain it. What I'm saying is that I would rather, if I was risk averse of 10, I would rather get a payoff of 27,000 than take a 50-50 gamble as to whether I get 25 or 55,000. That's what a risk aversion parameter is. I mean, you're so risk averse, you'd rather get a number almost the same as the lower amount than take a gamble over 40, over 55 to 25. Can I ask in the room, does people think that's a reasonable gamble? Or would you rather take this gamble? Would you rather get a payoff of 27,000 or take this gamble? Who would rather take the gamble? Right. That's nearly everyone in the room. Who would rather just get the payoff of 27? Small number of highly risk-averse of individuals. Good, okay. So in this room collectively, we seem to think that 10 is above our own notion of risk aversion. My guess, when a lot of us think that the true number is somewhere between 2 and 5, and probably that might be, once we get to 35, that might shake some of you out of the market at that point. And that would give us our measure of risk aversion. Okay? Now, I do it for another set of numbers, but I won't bother with that now. So what I want to do now is measure the quantity of risk. How much risk am I taking by holding equities, which I'll explain shortly. But before I explain it conceptually, I'll just put up a chart. And what this is showing is UK consumption growth as the blue line since 1870, and equity returns. And it's sort of illustrating a point you're already in. Equity returns are very volatile. You're on the same scale. But if you look hard enough, you can see that they're mildly positively correlated. And that means that when consumption growth is high, in other words, when you're already flush with money, equity returns tend to give you more money because they're positively correlated. It means that when you not nobody in this room, I'm sure, but if you've lost your job and your world's collapsed and your consumption growth level is low in the middle of a recession, it's at that time equity returns are low because they're positively correlated. And it's for that reason they're risky. Because what you really want from an equity is something, or an equity, is something that would give you a high payoff when you're poor. You would ideally want the equity returns, if you were holding equities, to be high when you've lost your job, so it would give you some money. And when you're flush, you wouldn't care so much if the equity return was low, because you had money in your pocket anyway. So it is indeed the observation that equities positively correlate with the business cycle and consumption that makes them risky. They don't provide you with an insurance. And because they don't provide you with an insurance, in order to hold these damn volatile things, you want an excess return, a premium. That's where the idea comes from. Simple as this. And so, what we have, in fact, are two legs of the argument. This is just a log. Forget about that, it doesn't particularly matter. But this is the expected return on equities, ER of E. And I'm pretty sure this is the last equation today. So we've climbed the hill, and now we can see the vista. So don't worry, this is the last equation. This is the expected return on equities, and this is the return on a risk-free asset. We don't put an expectation in front because we know the return on a risky asset. That's the basic idea. And so we have an expression that says the excess return, or the equity premium puzzle, is determined by our coefficient of risk aversion, this little guy here, and the covariance of consumption growth with equities. Now, we've just seen that that's positive, but if we're going to get this excess return explained, we need to measure the covariation of consumption and multiply that by a coefficient of risk aversion to explain the high rate of return. That's how we estimate it. So we take that observation, we estimate the covariation, we're then able, if we've got the average excess return, to work out what the underlying level of risk aversion must be to explain that excess return. And we're going back to the idea of whether it's an equilibrium or not. And so here's the answer. The UK excess return since 1950, just the year before Churchill came back as Prime Minister, other sort of famous Labour administration, 45-51. The average excess return is about 3.5%, with a mildly positive covariation of 0.3%. It implies our coefficient of risk aversion in aggregate has been 12, if we're going to explain the excess return. Most people in this room would now say that's far too high. I don't believe that number. Because it means we'd rather accept a payoff of around £26,000 than take a gamble in which we're 50-50 likely to get £25,000 or £55,000. Richard would be happy with that number. So let me illustrate further this idea about risk and movement over the business cycle. An asset such as a share price, let's imagine this is our notion of permanent income, where we expect our permanent income to grow over time and over our lifetime. And let's suppose that over the business cycle, our consumption is somewhat constrained, we can't always borrow against future income, or we can't perfectly share our risk or hedge it with other individuals, so that over the business cycle, our consumption moves mildly to the upside and mildly to the downside and then mildly to the upside again. But we have to accept some consumption variance. Not a lot, as the previous lecture demonstrated, and you're welcome to go and read it or listen to it. But there is some covariation in consumption. And so a share price that is both volatile and positively correlated with it doesn't really help you hedge this position. Because when your consumption is low, the equity price is low, it doesn't help you get this consumption back to trend. Not very valuable. On the other hand, asset prices that move negatively with consumption will provide exactly that hedge. When your consumption is low, the payoff is high, and you can drive this consumption back to trend, reduce its volatility, and you feel better off. Now, if equity prices are indeed positively correlated, they're risky. Maybe the equity premium puzzle or the size of the equity premium makes sense. On the other hand, given that the positive correlation is not that large, we still need a very high level of risk aversion to explain it. Now, one thing that might have distorted the relationship between equity prices and asset prices and consumption of the business cycle may well be the operation of policy itself. Both financial and monetary policy, particularly in the 2000s, was almost operating in a way to try and offset negative movements in equity prices. Following the dot-com crash in 2001, it was thought that monetary policy was being engineered to try and elevate equity prices. So rather than, let's suppose there's been a dot-com crash, equity prices start to fall. If monetary policy at this time becomes very loose or accommodative or provides a floor under which equity prices won't fall by offering to buy them if they fall below that level, by essentially offering low interest rates over the long run, I don't think that's for me. Perhaps we could just turn it off. Then the Greenspan put what it might be doing exactly the time that equity prices are tending to go down, might be pushing them up again here. And if they're pushing them up, what they're doing is changing the premium, because they're stopping them from being pro-cyclical and risky with a high premium and making them less risky with a lower premium and raising their prices. Because I'm going from a world in which the share price is risky, I need a high return, to a world in which the share price has become less risky and I need a low return. And what I might therefore see is a long trend movement up in prices as policy is distorting these relationships. And that might be one reason that we don't actually see a very stable equity premium if we look over the very long run. Okay. Now, there's a whole bunch of explanations as to why the equity premium may be high and may be an equilibrium or disequilibrium phenomenon. One is that it might not be stable. Second is that when we look at equity returns, we may be overestimating equity returns because we're not removing from the index those firms that go bankrupt or disappear. So if we're doing that year on year, we may not be accounting for the lower actual returns you get in investing in equities. When we compare to treasury bills, they're very liquid instruments, almost like money. And just like money gives a zero rate of return, but we're prepared to hold it, a very liquid instrument like a treasury bill may be bought at a very high price, and that would tend to lower the interest rate. That's lowering the denominator, it's increasing the premium. So there may be some other distortion introduced because we have a wider set of interests than just hedging our aggregate business cycle risk. As I've already hinted, perhaps my utility function is garbage. Another argument is that there may be heterogeneous households. In that, we've seen that the correlation of equity with consumption is mildly positive, but it could be that the kinds of households who buy equities might have a much stronger correlation with equity prices. And therefore, we might be underestimating the correlation. And to the extent to which we underestimate the correlation, we would overestimate the coefficient of risk aversion. If the actual correlation between richer households and equity returns was higher, the underlying risk aversion parameter would be correspondingly lower, and more like the 2 or 3 or 4 or 5 number that we collectively think is more appropriate. Finally, equities might give a very high return because of disaster premia. Suppose every 10 or 30 years, equities fall by a very large amount. On average, we don't have to worry about this, but because they might, we ask for this higher premium, this higher return to compensate us for disaster. There's a whole bunch of things there, and I guess part of my job is to introduce this literature to you, and you can spend time thinking about it later. In fact, a colleague of mine said, "You're giving only one lecture on the equity of premium policy." He thought it could have been the whole of my series this year, but I think that would be pushing it. There are certainly some references in the transcript, and I'd encourage you, if you're interested, to look it up. I made a point that the equity premium is not terribly stable. This is the UK data. We can do this back to the early 18th century. All I've done here is taken a 50-year window, and I've just rolled it forward year by year. And here's our nice period in which equities return more than bonds. But if we have these substantive periods, this is the 18th century with all the shocks and wars and everything going on, and the 50 years up to the mid-19th century start to look positive again. But then once we get into the mid-20th century, we get this large period of world in which the equity risk premium isn't positive, is negative. We have to account for the fact, therefore, it's not very stable. And what I want to do in the next 5 minutes before I conclude is just run a simple strategy and try to understand that a bunch of people born in the 20th century, if they'd saved over 40 years of their life in the US and the UK, what kind of final amount of money would they have ended up in if they used a bond or an equity strategy? The idea is that if we thought the equity premium was constant and always obtained in all states of nature, we would imagine that the equity strategy would always dominate the bond strategy. It's the one we talked about at the beginning. If, on the other hand, it's very variable, and we don't quite know what it's been, we may well find, under certain circumstances, the equity strategy doesn't do that well. And that's what all we want to do, is try and illustrate that idea. So I set up a very simple simulation. We're going to invest £100 or $100. We're going to do it for the UK and the US. And think of the first individual is starting in 1965. So he or she is 25 in 1965, therefore born 1940. And they're going to invest for 40 years, all the way up to 2004, 2005. And all they're going to say is that they're going to invest £100 or $100 a year in real terms. So they start with £100 in 1965. In 1966, the £100 is uplifted by whatever the RPI or CPI is. So it's just a constant, real-term £100 investment. For those who start earlier than 1965, because I run this from 1950 to 1970, they start with a number slightly less than 100 because the price level prior to 1965 was lower than it was before. But all it is £100 in real terms over 40 years. So we know how much they've put in real terms. Okay? It's £4,000. And at the end of 40 years, for every cohort, we're going to plot the relative payoff from bonds to equities. So I'm just going to show the final pot for bonds relative to the amount that you've put in, the £4,000 you've put in, and the final amount for equities relative to the final amount you put in. And the chart should therefore simply give us an indication of the excess return of equities to bonds, how much better you would have done in one as opposed to the other. What are the sources of uncertainty? Well, the year you're born is going to determine how well you do early on, if it's a good or bad draw, and that's going to accumulate over time. And the year that you end, of course, towards the end, is going to give you some notion of your final pot because all the money's been accumulated. So these endpoints have a big impact on the final result. And you should ask yourself socially whether that's a good idea. Should it particularly matter for someone's final pension payout or savings at the end of their life that the amount could vary a lot depending upon the year they're born, which is essentially a random phenomenon? I use 1965 as, you might say, why have I chosen that year? No particularly good reason, just happened to be the year that my parents met, which I thought was a good year. So think about the nominal part. And I do it for equities and bonds, and I also do the exercise for a mystery asset in the UK. I'll see if we can guess what a mystery asset is. Let's see what it is. So for the US, now, you're not going to be a genius to know the red line is equities, and the blue line is bonds. So, just to explain this, we've got a 40-year investment strategy. We're 25 in 1951. We're investing for 40 years, and here's our terminal payout in 1990. The blue line is from the bond strategy, so I end up with around 3 times the amount that I put in if I invested in bonds. Had I invested in equities, I would have ended up with the same amount in 1990. As time goes on, particularly if I start in about 1955, I start to do very well indeed. And if I'm starting in 1955, I'm actually born in about 1930. So the kind of peculiar thing is that those people born in 1930 through to about 1940, the Great Depression cohort in the US, did very well from an equity strategy. It almost seems like a payoff for having started your life in the Great Depression. So yes, the equities do well, but increasingly less well once the terminal date goes into the 2000s. Collapse of the dot-com boom leads to a large random change in outcomes, and of course the financial crisis does the same here, but the trend looks down. That's the US. So there is some evidence equity premium puzzle, but the risk you bear, you can see compared to bonds, you can be fairly sure you're going to end up with 3 times your endowment, however you do it in bonds. If you're very risk averse, you're going to want the bond strategy. On the other hand, with equities, you could in principle end up anything between 8 times your endowment and only 3 times your endowment. All that pain of every day hearing the newspapers telling you you've lost or made money. That might be something you may not be very happy about. Actually sounds a bit like my father, who's always banging on about how much he's got. In the UK, it's a very similar pattern. But the excess return, as I've hinted, is not as large. We just don't have the same level of equity premium in the UK. And part of the reason is that bonds tend to do slightly better. So rather than being at 3, we're at 4 in the UK, and that's sort of reducing the gap between the two for obvious reasons. And in fact, if we're risk averse, once we look for the cohort who are investing from 61 through to 70, so those born in 1935 to 1945, if they're mildly risk averse, in fact, they would probably, with hindsight, have preferred to invest in bonds throughout that period. Because in a couple of occasions, equities do worse. And some notion of the average of that would not take us very far away from bonds. I think it's very interesting. So despite this equity premium puzzle, because of this volatility, as you accumulate over time, you may not end up with the high level of returns you might expect. Now in the UK, I've introduced a mystery asset, neither bonds nor equities, and imagining, which there isn't of course, there's an index for that asset in which you can invest and accumulate over time. That asset didn't do terribly well for the investor in the 90s, but still did as well as bonds, and in fact did significantly better than equities if we held it through and cashed in 1990. But certainly in the last decade, the first decade of the 21st century, this mystery asset has done very well and may, in fact, have suggested that we've diversified away from equities that were not giving us a significantly higher return into this mystery asset. Can anybody guess what this mystery asset is? You're brilliant. You told me they'd be good. Absolutely right. Housing. Sorry? Yes, it is. It's a house price index. Now, there's a lot of uncertainty over house price indices, and this is an aggregate UK index. So if this was London only, this would be not quite so bad in the 90s, but I just wanted to do it in aggregate terms. You can play with the numbers if you want yourself in your own time. It's kind of interesting. Now, we do this again for the UK, but rather than that 40-year horizon, remember the bonds are the tortoise and the hare are the equities. Over the very short horizon, actually, it's not terribly clear that equities dominate bonds. So if we were characterizing equities, over the short horizon, it seems likely that this hare will take a break of uncertain duration, such that the bonds don't clearly do worse over time. And so that if we're saving over the very short run, bonds may be more attractive to us if we're risk averse. because we can always seem to be able to get more than our endowment in bonds no matter what. So it might be the thing that we save in if we're looking towards putting a deposit on a house. So when liquidity matters, both equities and housing look risky, and if they're risky, they actually need a premium over bonds. I don't mean premium bonds, that's something else. I mean a premium over bonds. Okay, I'm going to conclude. When we think about equities, we have in our minds news headlines, the first item on the news, which is often equities have fallen by 15% today, this many billions has been wiped off firms' prices, oh, woe is me, disaster. And then we sort of see the bell at the New York Stock Exchange toll. And for those people of my generation who had to study John Donne in second form English, we know exactly what it means when the bell tolls. It's not a good sign. So the metaphor of bells tolling and equity prices falling is quite prevalent in economic commentary. This makes us very nervous about equities. And what we can see is that if we're going to think about an equity premium as economists, we have to think about both risk aversion and the variance of returns, how uncertain they are, and in particular with respect to consumption growth. And whilst the US post-war data, which has been the source of much research by colleagues and people in the profession, does suggest a free lunch, the question I would then ask is, has that held back growth? Because it means capital has been expensive. And of course, the elasticity of output with respect to the cost of capital is negative. If you raise the cost of capital, you'll tend to lower the level of output in the economy. The UK data, to me, altogether seems less clear. There's considerable evidence of less dominant returns. But the question I might ask is has this held back savings? Have we not stuck as much money into the equity market as we might have done because the returns, we're all smart, particularly in this room, myself accepted, of course, is that we've decided that equities don't pay us enough for our return, and therefore we've diversified into other assets such as housing. Whether that's good socially or not is a very difficult question. But many of us do believe we have a housing crisis at the moment. We kind of wonder whether some of the distortions elsewhere in the savings may have contributed to that problem. And so, rather than necessarily thinking that the equity premium is a puzzle that we can't solve, I think it's something we can understand reasonably well. And what I'm intrigued by is the reaction of many investors to what they see as returns and the way that they're able to diversify their portfolios. Thank you for listening.